So what are the main order types in the Thinkorswim platform? In this video, I'm going to talk about the difference between a market order, a limit order, a stop loss order, and a stop loss limit order, and how you can use them in your trading. Hey, how's it going? On this channel, you will learn the steps I took to go from trading with a full-time job to trading as a full-time job. So if you're new here, consider subscribing. And at any point in the video, make sure to check out the notes and links in the description below. I'll list out any valuable resources down there. Now today, we're going over basic order types in the Thinkorswim platform. The first order type we're going to talk about is a market order. Now to see those different order types, just when you have a buy or sell order open, you just go to the order type and then click that tab and it will pop those different order types in. Now the first one here is a market order, and all a market order is you're telling it that you just want to get in at the current market price. You're essentially saying that I don't care what price I buy it at, I just want to get in right now. And so generally with market orders, you will instantly get filled, or you'll instantly buy or sell whatever stock you want. And market orders are good for buying into a strong momentum move that a stock is having. If it just keeps going up and up, or just keeps selling off really quickly and the price just keeps moving, a market order is probably the best way to try and get in or get out of a trade in those circumstances. But generally, try and stay away from using market orders because they can cause slippage. Now, slippage is essentially you getting filled at a worse price than you thought. So if the market is trading at 280 and you put in a market order, you might actually get filled at 279.95. So it's not a huge deal, but over the long term, losing those 5 cents over and over and over, especially if you're trading a lot of shares, can definitely add up. And so you definitely want to be careful with using market orders. They shouldn't be your go-to kind of order when trading. You should only really use them when you really need to get in and out of a trade and the market is moving rapidly. Moving on to the next order type, we have a limit order. And so a limit order is you telling the system the exact price you want to buy or sell shares at. So you can tell it to buy shares either above the market or even at the market. So it's another safer way to try and buy at the current market price so you don't have slippage. You can just, if the market is trading at 280, you can tell it to buy at 280 and you most likely will get filled because the market's trading around that area. But another thing you can do with limit orders is have them so you can designate when you want to buy and at what price. So if a market is trading at about 280 and you want to buy at maybe 279, you can put a limit order in down here at about 279, and when the market comes down to that price, you will then buy it. So it's a way to essentially, you can automate your trading by telling the system that you want to buy shares at this price, and so you don't have to watch the market all the time and wait for the market to come down to that level to put in a order. Limit orders allow you to designate the price you want to buy or sell at. So if you had already bought a stock, you could place a limit order above the market up here, and then when the market price traded up to that level, you would then sell, and potentially you could have sold right at support, maybe when you weren't looking at the market, and then you could come back and see that the market had already sold off. And because you had a limit order already there, your shares would have sold and you would have locked in that profit without having to worry or pay attention to the market all the time. So limit orders, you can either use them to buy at a lower price or buy at the current price without having to worry about slippage, or sell at a higher price so you don't have to worry about managing your exits on your trades as closely. Now, the next order type is a stop loss. Now, the next order type is a stop loss, or how Thinkorswim has it is they just call it a stop. Now, a stop is essentially a limit and a market order put together. So how it works is if you wanted to have a buy stop, you tell the market where you want to buy. So buy stops are used for buying into a move essentially. So if you have a buy stop at, let's say, 283, when the market trades up into 283, you essentially tell the system that I want to buy here, and it will convert your buy stop into a market order. And so then you will send a market order into the system at 283 and get filled at pretty much 283 with that market order. So this is another way to kind of automate your trading and essentially buy into a move if you think that once it gets up to 283, I just want to buy it because, you know, maybe you're using some kind of breakout strategy. Now on the flip side, you can use this to get out of a trade if the market moves against you and gets to a point where you just want to get out of the trade. So if you had a stop loss set at, let's say, 277 and the market traded down to 277 and hit that stop loss of yours, or the stop, you would then have a market order sent in to sell your shares at that level, and then you would then be out of the trade. You can also use this kind of setup to either short the market or close a short, just on the kind of flip side of how you enter the trade. You can also use this to short the market if it gets down to a certain level as well. You wouldn't have a position open at the time, so having a stop loss here would actually make you short shares, and then you would be short a position, and you would want to then probably place a stop loss up here somewhere to close out of your short position if the market got up to a certain point where you didn't want it. Now the last one is a stop limit, and this is essentially the same as a stop loss or just a regular stop. The only difference is once it gets to that level that you potentially want to buy or sell, the system puts in a limit order. So this is actually, you can change the limit order to whatever you want. So if the market traded up here, one way you would use it is once it got up to this level, you would send in a limit order at that level to buy it. Now that would just, you know, reduce the slippage that you're going to get. But because it's a limit order, if the market just blew past that level without your order getting filled, you do run the risk of actually not getting filled at that price and having the market leave without you. So sometimes in a rapid moving market, you do want to have those market orders instead of the limit orders, with running the risk of just having a little bit of slippage, but you don't run the risk of not getting into the trade. Another way you can use this though, because it's a limit order, you can have the market hit this level up here and it can put in a limit order at a different price. So if you think that this price is a resistance level, but once the market gets there, you want to get in at some lower price because it confirms some kind of strategy for you or some kind of trend, you can set in a limit order at a price down here. So the idea is the market gets up to this level, you like the stock at that point, but you want to buy it at a lower price. You can wait for the market to come back down to this level, and then that's when you would actually buy it. And then hopefully the market would bounce off of this level kind of, and then you would have a potential profitable trade from there. And then of course on the flip side, you can use this to get out of a trade as well, or even short a market. Once the market comes down and hits your stop, you can have a limit order wherever you want. So you can have it again at this price of where your stop was, or up here where maybe you think the market's gonna have a quick rebound to, or even down here at some price where you would really want to get out of the trade. You can just use it any way you want. Now, to give a quick recap of all the types we just went over, a market order gets you in right at the exact price of the market, but again, you can get some slippage. A limit order allows you to buy at whatever price you designate. So you can buy it at the current market if you want to get in right now, but it doesn't have that slippage issue, but you might have some fill issues if the market is moving quickly. But you can also use it to buy when the market maybe has a pullback. And then a stop allows you to buy when the market gets at a certain price. So if the market moves up to a certain price, you can have it send in a market order and you can get filled in right away when the market gets to that price. Or you can use it to sell when the market hits a area that you want to get out of in a trade. And then we have a stop limit, which allows you to pretty much do the same as a stop order or a stop loss order. The only thing is, once it gets to that price that you want to sell, you can change it to a limit order and just change it around where you actually want to get filled for that trade. Hey, thanks for checking out this video. If you want to learn more about the Thinkorswim platform and different order types in the Thinkorswim platform, make sure to check out my other videos on the Thinkorswim platform. Now, if you want to just learn more about trading and the stock market in general, make sure to subscribe to the channel. If you have any questions, feel free to ask them in the comments below.